Here we are, Ways and Means, still Tuesday, the 28th. It is 2:05 p.m. We are picking back up our committee bill. We have Pat Titterton to join us. Thank you, sir. We went through the words, but everyone wanted you, Pat, though we like Kirby.
It always makes me so popular. Patrick Titterton, Joint Fiscal Office. Scott, I need to hit you. Yes, thank you. So yeah, you went through the two proposals, one including the healthcare provisions, one not, right? So I am going to share with you a bunch of tables that show some of the income distribution and how their tax bill changes, what that would look like under both scenarios. And just like when I was in on this bill last time, their first several slides are the ones that you've seen already, but I wanted to include them just if it is useful to the committee to have them for reference as we're going through this. As I mentioned, it has the whole shebang, the whole income distribution and effective tax rates. It has information on income for the top 1% and their distribution and what they're contributing currently, how that's looked over time, a little bit of information about the age breakdown and the demographics of taxpayers in Vermont. And then just for reference, that map showing you the top marginal rate in each state. So
Yeah.
So Patrick, already I'm seeing in that first line up there, the top bracket of being 7.4. What happened to the 6.8? Right, I haven't seen 7.4 before.
sorry, could you let me know which slide you're looking at?
On page 2.
This one?
Yep. 7.4 over here for the million plus. Oh, 6.8.
Okay, yes, no, that's a good question. So that refers to the effective tax rate. So it's not the marginal brackets that you're familiar with in all of these. It's just, if you just take their income and their tax, basically what percentage of their overall income is being taxed, personal income. So it's kind of like their average tax rate in a way. It's not referring to any marginal rates.
Okay,
Remember, their income will go through all of the brackets.
thanks.
Yeah. Okay, so the first proposal, this is the proposal that Kirby walked you through that includes those three healthcare provisions. And it raises the top marginal rate and includes the investment proceeds tax. So the cost for the first two healthcare provisions, no one communicated to me, was estimated to cost about 75 million. So you'll see that the brackets have been constructed in a way to raise that amount. And then the second piece, which is the credit for the employer covered portion of insurance premiums, using again some information that no one was able to provide. Constructed a structure that using that information that would cost about 42 million, which again, calibrate that rate on the investment proceeds tax to cover that dollar amount. So again, that's 42 million on those two bullets. And just for reference, just want to remind everyone, this is the existing marginal bracket structure in Vermont. You can see that low rate at 3.35% and the current top rate at 8.75%. And this is what Kirby's language showed, we would be moving to. So maintaining that 3.35 existing bottom rate. The first three rates actually are being maintained here, but you're seeing that where the top bracket starts is being shifted out. We're not adding a new bracket. We're just shifting the starting point for that top one and then increasing that that tax rate from 8.75 to 12.4%. So one thing that I want to point out in all this is that there is going to be a large portion of income, between the third bracket and the top bracket, where that income was previously being taxed at 8.71, but now because of the bump out of where the top bracket starts, a lot of that income would then be getting taxed 1.15% lower at that 7.6. So there are certainly people, going up to that new top bracket, and even as you get into that new top bracket, who will also see some tax decreases, which you will see on the coming slides. Again, these were constructed to raise approximately 75 million in revenue.
In order to cover the first two sections of the healthcare.
Yes, so this construct is meant specifically just for those two. The third one is treated with the investment proceeds tax.
And so if folks want to keep the whole healthcare proposal together, but not have the investment proceeds tax, then this could change, or some other piece of the spending could change. Just logicking out the situation.
So the next several slides are showing sort of that income distribution. This first one is including all filers, all resident filers, I should say. I have the brackets equal to the married filing jointly, but you'll see in the next ones that obviously different things happen at different income levels. So because those two bottom brackets we're not touching in this proposal here, you're not going to see any tax change in those income ranges. But that sort of dynamic I was talking about, where with the bump out of the top bracket, and that some of that income being taxed at 7.6 as opposed to 8.75, that's where you'll see people in this income range seeing some tax decreases. And then, of course, the majority of which is being raised by this, should say. I copied and pasted in the wrong table.
I was like, where is that 12.7 coming from?
Let me see if I have the sections mixed up. That's not what you want. Okay, so that's a shame. I will have that corrected and updated so that you're looking at the right thing. So I guess what I can try and do is talk through it a little bit.
You want to edit? Are you in PowerPoint right now?
I am in PowerPoint, right? I am in PowerPoint.
Good. Do you want to, is it just,
It looks like all the tables in this section are from a previous proposal you looked at.
okay,
But the second proposal of the tables are correct. I just looked.
are you able to edit it while we're sitting here, or is that crazy?
Let me see if I can do one thing. I'm going to stop sharing for a brief moment. And I'm going to pull up Excel.
I want to bring up a concern that I have that Pat and Nolan brought up to me the other day. Which is the cost of the healthcare stuff and the revenue from the income are sort of like chiastic or counter-cyclical with each other. So in an economic downturn, the healthcare costs will go up. And in an economic downturn, depending on the type of economic downturn, the revenue might go down. And that won't work out all that well. There is sort of an interesting piece with how the last few recessions and recoveries have had that sort of why the alligator mouth, right? K-shaped recovery or whatever you want to call it, where sort of the top 1% actually has been sort of doing very well no matter what. But I don't know if that's the top 1% nationally or the top 1% in Vermont, which are two very different top 1%, income wise and wealth wise. So that's an interesting thing for us to reckon with. I wonder if Nolan, you want to add anything on that while I.
The only other thing I might add is that in economic downturn, the last several, the federal government has stepped in to provide assistance to state governments and healthcare Medicaid seats unlikely.
Unlikely in the near future.
Near future.
We've gone to the source.
Hello, source.
Good news is the only thing that was mislabeled was that rate. That's important, but the average tax change in the filer counts, that stuff was all right. So the table we were trying to look at that was mislabeled and
This as well.
is this. So this is what we were just looking at. This refers to all resident filers, this particular table. And again, you'll see that dynamic where the individuals in that third bracket, some of them will be seeing a tax decrease. But again, the majority of the revenue is being raised on that, top new bracket, that top 1%, bump out of the top bracket. And you can see here again for all these filers, the revenue estimate for that is about 75 million, equaling the estimated cost for those first two healthcare provisions. And so what these other tables are really just looking at the same thing, except breaking it up by filing status, right? Because we're going to still have different brackets based on what your filing status is, but same rates, of course, throughout. So for married filing jointly, those are the same brackets that I was using for the all filers. You can see that these individuals would be contributing about $60 million of that revenue change. So, the majority of the revenue would be coming from married filing jointly filers. Married filing separately, a much smaller portion of all of this. And again, you can just see how the different rates apply to different income amounts based on their filing status. Single, the most by count of filers, this is the largest cohort of taxpayers in Vermont, or tax returns, I should say. And so, but they're, as opposed to married filing jointly, contributing about 60 million of the increase, about 12 million would be on increased taxes for single filers. And then lastly, head of household, 2.1 million from those. And you can see consistently with all of those filing status tables that those folks in the third bracket would be seeing some decreases with this construct. Okay. So we are going to go back into PowerPoint. Get this terrible slide off the screen. To then talk about the change to the investment proceeds tax. So again, this is just showing you a distribution of Vermonters who pay the federal version. The majority of the revenue is coming from those folks with $1 million or more in AGI on the federal side of things. Overall, it's applying to about 12,000 Vermonters pay this federal tax. Now, the language Kirby showed you, where this proposal is structured very much the same as the federal one, with the key distinction of the rate in the language now is set at 3.45%, which would generate approximately 42 million, which, when looking at the credit for the employer covered portion of premiums, if they received credit for about 12% of those costs, that would come out to about $42 million. So again, this is a situation where constructed this piece of it with the tax rate to match with the estimated cost of that credit. Now, of course, if you want to make the credit more generous, what do you have to do to keep it in balance? You'd need to be increasing the tax rate here. Same is true if you wanted to reduce the rate on the investment proceeds tax, you'd have to then be decreasing the credit to keep it in balance. So this is sort of summarizing the different costs and revenue raisers. First there you have the PIT bracket and rate changes. That's that 75.2 million. There's the VIP tax, about 42 million, which is sort of constructed to cover the 75 million, 37.8 billion, and then one piece I haven't mentioned is that one potential, and if you all want more details on this, I might defer to Nolan, but with that credit for the employer covered insurance premiums, there is an expectation that claims assessment would decrease, and Nolan has that estimated to be about 3.5 million. So sort of included in the estimate for the cost of that credit for employers.
What did you just say?
The employer says nothing.
Or sorry, yeah, the employer assessment. So when you put all these pieces together for fiscal year 28, the outlook's looking at about pretty much revenue neutral, but with some rounding. So that's where the 800,000 net positive comes in there.
So just so I understand this, the qualified health benefit, that 75 is money that we are paying out from what we collected in increase in income tax. We're paying it back out to help bring down the healthcare costs of certain Vermonters. Is that correct?
Yes.
Okay, and then how does this employer premium credit thing? That's money going into employers.
Mhm.
How?
So I'm sure Kirby will correct me if I say anything wrong, but there are some requirements on the size of business that this applies to. I think it's 100 employees or less.
Yes.
He's nodding. And so basically, if the employer is offering health insurance to their employees and covering, I think on average, employers are covering like 73% of insurance premiums for employees. That dollar figure amount that they're covering they'd be eligible to receive a credit for from the state to sort of offset some of their costs.
You mean 73% of Vermonters are receiving?
No, so if an employer offers insurance, typically there will be an employee contribution, and then the employer will cover the other portion of their premium.
Yes.
The average rate in Vermont is employers are covering about 73% of the premium. So it's a 12% credit for the employer portion that they're covering.
12% of the employer portion
Yes.
becomes a credit.
Yes. Yep.
Okay. And that totals 37 million, 38 million. Okay. All right, and how do they claim that? How do they get it?
I might defer specific to Kirby on the specifics of the administration.
Sure, so for me, much to the council, when this is written up in the employer, or when they go pay their income taxes, would claim it as a non-refundable credit, so reduce how much.
So, okay, to follow up on that, would that just kind of come out of the quarterly withholdings that the corporation is making, or their extended estimate? It could be.
Yeah, it's a good question whether it would come out quarterly or if it would just be when the returns filed the end of the year. Might have to consult the department about how that checks out.
Oh, the government, you mean the tax department?
Yes.
Okay, so they're all aware of this and they think they could do it?
We haven't heard testimony from them yet. Representative Burkhardt.
So does this 37.8 million cost include any assumption about employers who might expand or might get into providing health insurance who don't right now? Or is that just on the base that are providing insurance right now?
Nolan and I had that exact conversation just the other day. So we have included some buffer, but it is somewhat unclear on what uptake might look like. And I do believe that the 3.5 million for the employer assessment piece there was related to uptake. Opting to start offering insurance and covering some of the premiums because of the credit.
It's
Representative.
Can you tell me that you just barely mentioned the claims assessment decrease 3.5. Can you tell me how that's supposed to work? And how you arrive at 3.5?
I would rely on Nolan to answer that.
For the record, no language of this process. So the way they play the employer assessment works is employers pay, I think it's roughly $300 for uncovered FTE. So the assumption is, on the first floor, excluded this all the stuff, right? And so the assumption is that as employers decide, oh, now I got a tax credit that's incentive for me to provide health insurance, they no longer have to pay that claim that employers. So we're making some assumption that they're not paying for uncovered FTEs because they're no longer covered, like a certain number. So we made some assumptions.
So it's a negative. Wouldn't
Yes.
that be a positive to us, the state?
What we're saying is that because there's less, potentially less covered FTE, because they're covering people, which is a good thing, we're gonna lose some revenue. So we have to offset. Some offset.
Oh, right, because the employers are paying into us, right?
Employers decide to cover their people,
Yeah.
therefore they don't have to pay, they're not getting penalized for not uncovered, or not having uncovered employees.
Okay,
That's what the
okay,
employers
I think I get that.
Yeah.
All right.
The Department of Taxes has a guide on what's called the healthcare fund contribution assessment, and I can send that out to the committee.
Thanks, Kirby. Representative Holcomb.
Yeah, and this is sort of actually where my question's in the same space. That's why I asked the question earlier about why people would choose the exchange versus the small business. And I wondered if there are other beyond the state incentives that might shape, because employers will be making the dynamic decision that's best for their bottom line. What are other factors that might influence that decision and affect these numbers?
Or get it all really well. So if an employer does not cover their employee, and their employee is on the exchange getting a subsidy, they are paying the employers for that too. So there was a lot of conversation about people back in the single payer days, there was a lot of conversations about employer dropping insurance for people to go into these public programs. I think Kirby said it earlier, a lot of employers use it as a recruitment tool. A lot of employers feel their responsibility to provide that benefit. So I don't think it becomes personal choice by the employer.
Other questions or thoughts?
I have a question, sorry, I think it's also for Shalom, which is, could you say another word about why healthcare costs and income are sort of countercyclical in a recession? Like, what assumption is being made there about why that is happening, I guess is just my question. I have some ideas or some assumptions about why that could be, but why is that the case?
My healthcare costs go up.
Yes, in a recession and income potentially goes down, because that's what the chair mentioned you had discussed previously. That those potentially could be countercyclical and we could be shooting ourselves in the foot a bit if we're trying to fund something that's going to increase with a tax revenue that's going to potentially decrease. My assumption, if I'm telling a story, would be that premiums would have to go up because maybe the market was doing worse, and so the insurance company is having to raise premiums, but I don't know if that's the story or what the story could be, because.
It's a long story.
Okay,
And it's probably a better conversation.
okay.
Okay.
I'm worried about this in part because there's such a rapid change in the market based on the federal changes, and most of our data is, we just don't have, I don't know if we have current data on what people are doing in response, and I guess that's what I wonder. I also wonder, what is the cost of not doing this? Because, one of the things, one of the healthcare advocate slides was talking about disenrollments due to failure to pay. And I wonder what's the cost of not backfilling in terms of uncollectible debt and other stuff in the system. We have no way of knowing. Maybe we should ask Representative Page or something.
Well, the other thing too is my understanding is this wouldn't take effect until January 1st of 2028, isn't it? Who's got 2 years still? And all sorts of things happen or not happening.
Very good point.
So you're saying vote for this and then. you
No.
Is that a motion or something? Hold on.
So what are we doing?
What are,
As a matter of fact, at some point, I'd just like to ask a process question. So whenever we have time, I don't want to take council or their full time, but
Okay, Representative Page.
I was just gonna say, so what are we doing in the meantime? It's 2 years. While we have this situation.
I don't think that's a question for Pat, though. It's a very good
No,
one.
I
Yeah. There's no, so one of the things that I think is, regularly comes up around taxation, right? Is that most of the more progressive and more effective and more base oriented, most of the better tax types and more responsible taxation, you don't have an implementation date right away because people are sort of planning their business cycle and their annual cycle, right? Based on the current tax structure. So good manners in the tax system is to have it be effective the next calendar year. And then it takes essentially a full year for that revenue to come in and be applied. And so I think there's always a chicken and an egg of why should we apply this now if we're not going to have the benefits for 2 years, but then in 2 years, we don't have the benefits of it because we didn't apply it 2 years ago. I don't know what to do for the next 2 years. And I don't really know how our hospitals are going to make it through the next 2 years. Representative Page? Year and a half, I guess.
Yeah.
Yes, Representative Holcomb.
Sorry, because we have so many initiatives like reference-based pricing that are supposed to be bending the curve, but they won't really benefit us for a while anyway. I mean, part of it is trying to find a stopgap until we have some solutions and
Well, it's not just our hospitals either.
No,
I hear you.
yeah, and people trying to pay their bills.
Yes.
Sort of maybe, yeah, right, importantly too. I'm gonna go back to Pat and see if anyone has anything on proposal 1. Does that all line up? People keep on telling me privately they want to take the VIP tax out. No one's saying it at the table, so I'm just gonna be the voice for all the people on the committee that have said that to me. If we do that, how would folks want to adjust the other things? Yes, Representative Wozniak.
I will offer something that's a compromise, not online before, but I would advocate for sort of, I don't like the phrase splitting the baby and I really don't want to use it, splitting the loaf. Of saying, keep the narrowed in VIP that's on the table here to pay for the small business tax credit. And use the 75 million in changes from the first proposal to adjust the brackets and do a little bit of both.
Representative Maslin.
Yeah,
I'm sorry, Pat, you are now sitting here through a committee discussion.
I want to see.
Mike Fisher's testimony about the benefits of providing better, healthcare rates. Well, business was very helpful, poignant. I'm still wondering about the narrative, but maybe we don't talk about that right now, about how we win the day on if we see if I can get my sentence to come out.
I think we're wondering about people's policy considerations on the VIP tax.
I'll save it for later.
Okay,
Thank you.
does anyone have any policy considerations on the VIP tax they want to bring to the table right now? Yes, thanks so much, Representative Kimball.
Yeah, I'm not a particular proponent of the net investment income tax as applied to Vermont.
you're refusing to use
I
this.
am.
So much better.
Because I do think it has drastic implications for business growth, small business growth and events and individuals' lives that are then taxed at sometimes the most vulnerable point, trying to exit a business or exit something else. So I'm not a fan of that anyway. And we've had some written testimony submitted to us that kind of corroborate that. So I would be happy to take it out.
Representative Rich.
I would say I would be happy to take it out as well. and then I'll go on further to talk about my procedure. I mean, you had talked about an implementation date further out as a courtesy or whatever for folks, businesses, whatever. I think it's the same as what we're doing right now. I have a real concern that, 2 weeks ago, this kind of all of a sudden came into play. Okay, so all of a sudden there's groups out there that must have a definite interest in this, that I'm anyway getting blasted by folks. Oh, Mark, you gotta pass the well type. You gotta pass, on and on and on. I've responded to, in particular, the ones that are my constituents for sure. Half of those came back as undeliverable. So I guess just to go further, we've only got another month, hopefully. I mean,
Knock on wood.
right, I mean, it's been talked about, maybe longer, maybe.
Let's not.
Anyway, so I don't, and we've already changed it. In 2 weeks, we've changed it from 13.3 to 12.7. We've got all these changes going on. I mean, if healthcare is going to be involved, the healthcare committee, I would think would definitely have to take some time with this. Got to go to the Senate, so I don't see realistically the time that we're spending on this. I mean, maybe it's a good exercise for sure. Maybe it's, will be picked up next year. Maybe it won't. Maybe if people have a clue as to what we're trying to do. I mean, I have a lot of opinions on what we've heard so far. But again, I don't think that our time is well spent with what we're doing here. I don't appreciate that the constituency out there really doesn't get it right now either. And again, for us to get it through the full process in a month's time, it's unrealistic for a truthful, realistic expectation. Anyway.
Appreciate that. I'll add sort of just a few process considerations. One, the Senate took a great deal of testimony. The reason the proposal was sort of shaped the way it did when it became a committee bill was that was essentially what the Senate had been taking testimony on for quite a while. They did not pass it, but had enough folks requesting that we pick it up and take testimony on it that we agreed to do that. We would need to finish our work and vote early next week in order to meet any of the timelines that are set up. And so that's what I was imagining. We have this testimony today, and then we're gonna have to turn to a few other things for the rest of the week and could probably squeeze in a little bit of time on this if we need to. But was hoping to get at least our policy thoughts on this today a little tighter. Representative Maslin.
Briefly. I think our time is being well spent, but I'm really waiting for the light at the end of the tunnel. This is gonna be useful down the line, regardless of what we do in the next several days, so. Anyway. Zip it.
Okay, thanks. These are sort of like the pressing issues of our time, so I think it's always helpful to talk about whether there is a path to passage or not. And I think it's very confusing for the public that we're working two different policies simultaneously, and I appreciate that, and I'm trying to reply to any emails from the public as I see them, and I think some of that information is being shared more broadly. Yeah, Representative Holcomb.
I wanna. Representative Page to be shot, but I'd like to lift up what Representative Page said, because I am concerned that with healthcare, we won't actually see the problem until it's too late. And especially when you think about what some of the leading indicators are, we'll be well into this problem. And so I appreciate you're trying to talk about these two problems in tandem, because I think we need to do something as a stopgap on healthcare while we figure out the new future state of healthcare as well. So I realize it's hard and it's gonna take a while, but if we don't do this, then we know that we'll be able to respond when we need to.
Yeah, Representative Bernie.
So can I ask a question of Representative Higley?
Sure, and then I think after that, we're gonna make sure we review proposal 2 with Pat.
Yeah, I think that would be helpful for us, Representative Higley, but are you saying then that you prefer not to do anything with healthcare costs, but instead, if we were to come up with some kind of an increase in revenue somehow, to just use it to lower, reduce income tax? Is that what you're preferring?
I'm preferring that if we really were serious about doing something with healthcare, we knew at the beginning of the year, and it should have been addressed through the budget.
I see. Do you want to continue to talk about reducing or increasing income tax?
Oh, I'll definitely talk about it, sure.
But you don't have a goal in mind.
I don't have a goal. I mean, my goal is, and, I have a whole entourage of reasons why we shouldn't do it.
Yeah.
But I'm not gonna go into that now.
So it's,
I mean,
everybody now knows we need to have a squirrel meeting.
So I'm gonna go to, Pat, I'm gonna ask you to take a pause from your time at the table because we have a witness in the Zoom.
Sure.
Who's gonna join us. And so we're gonna hear from two witnesses, and then go back to Pat to make sure we see the tables in option 2. Pat, you said you don't have to go back to approach? You do, but 15. Okay, this is all gonna work out beautifully, I'm sure. Okay, or maybe it won't, we'll see. Matt Clear, hello.
Good afternoon.
Good afternoon. I'm sorry to leave you waiting in the.
It was interesting to listen in on the conversation.
Good, you really got the juice of it there. So glad to have you. Thanks for joining us.
Absolutely. I'm happy to be here. And for those I haven't had the opportunity to meet before, my name's Matt Clear, a public accountant in with the firm Davis and Hodgson out of Williston, about 19 years in the profession, and here in my capacity as a board member of the Vermont Society of CPAs and former chair of the State Society as well. Although it sounds like a lot of what I'd sort of prepared as observations may be obsolete at this point, I'm still gonna
Please do.
run through a couple of observations I had on a draft that may not be the current one, is my understanding. But
Even, validation that we are, that if you critique something from the past and we have changed that, that's nice to hear too. So don't feel that the time is wasted. We're glad you're here.
absolutely. And to be clear, I'm not trying to specifically critique anything. There's just some observations that I had about what I read at the time. And feel free to jump in and correct me if it's already obsolete. There's a minor change in terms of the draft that I'm looking at with the married filing joint tables. On line 10, it had what I believe is a mistake for the taxable income level. And so I figured I'd just point that out since I was in here. It lists that the top bracket or proposed top bracket in the version I'm looking at, which is 12.7% bracket, would kick in at 312,000, and I believe from the rest of it, the intent is that would have been at 586. So I don't know if that was something worth highlighting here.
Thanks.
Most of my observations have to do with subsection 6 and also on the VIP. I think that's what or VIT, the Vermont Investment Income Taxes people are throwing around. Subsection 6, I was curious what the intent is of this. Sort of, it's almost like a minimum tax for a number of reasons. One is having the threshold set at an AGI of 150 doesn't really take into account filing statuses like other things do. So it creates a kind of a different sort of engagement point depending on what your status is in terms of what your family's income is. And also because it seems generally in tax policy, I'm of the opinion that cliffs are a bad thing. And when you have this sort of minimum tax that sort of kicks in after a certain point, you do create a cliff where, family can earn $1 more of income and end up with a situation where they owe quite a bit more in taxes. And generally, that's not something you want to build into the tax code. And the way this is worded here, or at least my understanding of how this would be applied, it does create a cliff between, 149,999 and AGI and 150. it also in certain, because I did run a few scenarios out of my own curiosity. And it does seem like it creates this weird area bubble between 150 and AGI, and depending on filing status, different points where it doesn't seem like it'd be more middle income people that would be hit and affected by this, because based on the higher tax rates in the higher brackets now, it wouldn't really apply to anyone other than those who just sort of crossed into the threshold for a period of time before their income got high enough that they'd be having enough tax, that 6.6 or higher bracket income, based on the calculations I did myself. And I don't know that that would be the intent of something like this.
Can you
But
explain more about what you mean by that?
yeah, so I ran a few scenarios. One, because I wanted to specifically look at situations around where the capital gains exclusion would happen on, like, sale of a family farm, somebody's retirement, and long-term capital gains, that 40% exclusion we have. And so I ran the numbers for just really simply, family of 5, married filing joint, what would their total taxes be at 149,999 of AGI compared to 150? And it's about a $660 increase based on just one more dollar of income, because this 3% additional amount would kick in right at that $1, and it seemed like a big jump there. And then based on the rough calculations that I did, it seems like it kind of starts to even out again once you get to about 169,000 in AGI. So it creates this weird bubble where only a very limited subset of Vermont taxpayers would actually be effectively paying that additional alternative tax calculation, if you will. Am I doing a
Yeah, that's perfect. Thank you. Yes. Appreciate that.
And then with that, the thought around, in specific, I'll give the example, they sell the family farm, that's kind of the retirement account. We've got that great 40% exclusion on the long-term capital gains from it, but that's not excluded from the AGI calculation. So there are situations where somebody would have a relatively low long-term capital gain that would be eligible for the exclusion, and potentially be paying this other tax. And so those were the two kind of numbers that I ran there, that it just struck me as it didn't feel like it fit with the rest of what I was seeing, which was kind of an expansion of the lower brackets, the lower income, or the lower tax rate, actually, at some of the lower income levels.
I'm trying to figure out how this parallels federal taxes, and how the NIT is used at the federal level and capital gains exclusions at the federal level.
Right.
Because when I look at our proposal, it does seem like this weird counterintuitive thing with the capital gains exemption and the VIP tax mixed together. But my understanding is that same weird mix happens at the federal level.
At the federal level, and I believe would actually be the case from the least draft that I'm looking at for Vermont, I believe all of the scenarios I can think of where the 40% exclusion would apply are also income that would be excluded from net investment income tax for the purposes of calculating it at the federal level. And I believe the definitions are the same in terms of what investment income is considered. So the way I read this, I don't know that you'd have that particular issue. But when it comes to chapter, that was at 149. I mean, taking a step back, the federal net investment income tax, I believe, was created with the ACA, and it was really about essentially adding something that was meant to be almost Medicare taxes on a class of income that didn't pay payroll taxes. The idea that your W-2 wages are taxed a little bit more heavily than your investment income, and I'm not saying I'm not expressing necessarily an opinion on that piece, but the idea or the way it was marketed as being fair is it was helping for like those living off passive investment streams that were significant would be also contributing into the system, which should help pay for healthcare for others. So it was meant to kind of emulate or build as emulating a payroll tax, and to add that to Vermont income isn't really the same thing because there isn't like a Vermont specific income tax that or payroll tax that this would be sort of offsetting on those types of income, if I'm explaining those. So that was something that stuck out to me there. The other thing, which is only really a nominal observation, was it doesn't seem like, so Vermont taxes tax exempt interest that is from other states' tax exempt debt. And it doesn't seem like that's accounted for in this. So that seems like the way that was worded, it would be excluded from the calculation of this tax, which I'm not sure if that was intentional or not. But those are my
Okay, thanks.
those are my observations about what I was read. It sounds like it might be superseded at this point, though.
That context about the payroll tax is really interesting. I knew that it was to pay for ACA stuff, but that sort of philosophical parallel is interesting. Thanks.
Right.
Yeah, Matt, I'm wondering because first of all, congratulations on making it past April 15th.
Thank you.
And from a client-facing perspective, and if you're in a position of advising your clients as to what they should be doing regarding how their income is structured, would the bill as configured change how you might advise them?
I don't know that it would change the advice because a lot of our strategies are around minimizing their exposure around net investment income tax when they can. I mean, sometimes you're in a situation where your dividends and interest and other income are just going to put you there. So it would just bolster those strategies around managing your income, and in particular managing things like capital gains and the timing of capital gains and whether or not to execute capital losses. So I don't know that this would change a lot of those strategies, but it would certainly increase the incentive to do planning around minimizing those taxes.
All right, thank you for that.
Absolutely.
Any other questions or thoughts from anyone else on the committee? Anything else you want to share with us, Matt?
Not based on any of this, but yeah, I don't know if there were any changes in anything that would make sense for me to speak to, but I appreciate being here and have an opportunity to speak with you all if there's no other questions.
I really appreciate it. And we are sort of definitely updating, changing brackets, changing exemptions, and we'll keep on sending drafts for comment if you're interested in continuing to participate in that. Okay. Thank you so much for your time today. I really appreciate it.
Thank you for having me.
Folks on the committee asked for testimony like on April 16th, and from an accountant, and it was sort of a funny moment here. So glad to have you. Thank you.
Would have been a lot grumpier then.
Yeah, absolutely. Take care. Back to you.
And still Patrick Turton with the Joint Fiscal Office. And yeah, so I am going to pull back up my slides. I looked at them while I had my little break there, and I did not make the same mistake with the first proposal. So we're not going to have to go to Excel.
I think it was kind of fun to get an Excel, but I appreciate.
So the general sort of request that was given to me was again, looking at moving that top bracket up with an increase in the rate. while at the same time in this version including the investment proceeds tax. And for all of the changes put together to ultimately come out to be revenue neutral. So I guess I'll just start walking through that. So again, these are the existing brackets. You can see two things that are going to change are that low rate is going to change. The highest rate is going to change, and then also where the highest bracket starts changes when we come to this slide. So basically the general structure here is with the money that is being raised with the investment proceeds tax and with the higher tax rate on the top bracket, what this does is it's lowering that bottom bracket. And it's been lowered to a point where essentially the money that's being raised is offset by the amount that's not being collected through lowering that bottom rate. And so just when thinking about why specifically the bottom rate, just remember these are marginal tax brackets, right? So everybody's income flows through all the brackets. So when you lower that lowest rate, you're lowering it for everybody. It's not like you make $600,000, that income is taxed at 12.4%. Rather, it's you know, they're also seeing those decreases on their income at the low end. So that's the change, and or I should say 10%. So again, this is looking at how all these changes apply to all filers and what the average tax change is by sort of income cohort. Again, these are the brackets that apply to the married filing jointly, just for reference. And you can see that with this construct on the personal income side of things, everyone who's within the bottom three brackets is seeing on average bill decreases, tax bill decreases. And again, that's a function of just taking that lowest rate and lowering it because that applies for everyone. And then that 10% rate that you see here, you know, that's generating here just within that cohort of individuals, an estimated 20 million. So overall, just on the personal income side of things, all of the, you know, increase in tax, but lowering for most people would decrease state revenue by about 42 million. Oh, wait. So again, I have the income distributions by the different filing statuses. You can see that for each of the filing statuses I have here, those bottom three brackets are seeing on average tax decreases. And so $42 million hole, it's in this construct being offset by the 3.45% tax rate on the investment proceeds tax. So really, on one hand, you're generally decreasing, but also shifting tax incidence on the personal income tax side, but replacing that overall tax decrease in personal income tax with this investment proceeds tax. So those two provisions put together sort of designed to largely offset each other and be revenue neutral. So that's sort of the second proposal in front of you that does not include any of the healthcare provisions, does change sort of the distribution in the personal income tax world and adds the investment proceeds tax to offset that. So it's a slight decrease, but we are talking 2 years out as well. So that's sort of the basic bare bones. It's a simpler sort of construct because it doesn't have the healthcare pieces, but you know, just generally speaking, largely designed to be revenue neutral.
Do you imagine that it would, this is the most obnoxious question, so sorry, that it would stay revenue neutral like 10 years out? I apologize.
Well, I mean, in a sense, what is happening here is you're taking the broadest base of income in the general fund and you're lowering the tax rate on sort of the in its broadest sense, that's that lowest rate. And you're concentrating more of the taxing, of the, tax capture, if you want to call it that, on the relatively smaller cohort of high income earners. So remember, when we talk about the investment proceeds tax, we're talking about about 12,000 Vermonters. And for that top 1%, we can jump back to that table. And all, that's about 4,500 filers, 4,600 filers. So there's going to probably be some overlap with the 12,000 there, right? But you're concentrating a lot more revenue on a narrower base. So anyway, that's kind of a long way of getting at. It does potentially introduce a little bit more. Actually, Graham was talking a little bit about this when he was talking about when he was here with you all, but it does increase the difficulty of forecasting a little bit, because with a narrower base, it's not quite as predictable. Something that is quite predictable with a huge base is something like sales and use tax, right? So maybe that's a long way of answering and saying that with some narrowing of the base that we're talking about here, it could introduce some a little more variability. It could, the investment proceeds one is very pro-cyclical, right? It follows the patterns of the general economy. If we are having a tough economic environment, it's likely not to perform as well because it is very much tied to market performance. And then conversely, if the market is doing quite well, there could be more people having this type of income and tripping into, over those thresholds that trigger liability.
And from previous testimony, I mean, not necessarily always true, but that income could be moved to a different jurisdiction. Can be planned more easily to take unearned income and move it into a different, whether it's into a trust that's located in a different state, that type of thing. I'm saying you're narrowing the base to have that, and then that's still vulnerable.
And when looking at the investment proceeds tax, the biggest component of that federally anyway, and then what would be true in this case as well, is that the largest piece of that pie is coming from capital gains. Capital gains is generally the type of investment income you'll have the most control over realization. So you can time sales to, whatnot. I think the testimony you just heard sounds like accountants are already doing that, advising their clients with respect to the federal version, right? So, yeah, that's a portion of it that, the taxpayer or the resident is going to have the most control over, sort of from a behavioral standpoint.
I'm gonna channel Representative Odie in her absence. Everyone just wants to prepare for that one. The idea of lowering the rate in the lowest bracket versus building more exemptions to focus our energies on that population. What are your pros and cons there?
Well, I mean, certainly credits and exemptions are always going to be much more surgical because you can really target specific types of either activity or demographic characteristics of taxpayers. So you can really focus the financial support through the tax code that you're providing, doing something like that with something that's but just lowering the bottom rate is a great example, something that applies to everyone. You're maybe not giving as generous on a per person who's eligible standpoint, but you're spreading those reductions in taxes, the most broadly. So on one hand, it's very targeted and sort of surgical, and on the other, it's sort of bringing, having it apply to everyone regardless of sort of their situation.
Any other questions for Pat?
Thank you.
Thank you, Pat.
And I will send Scott corrected slides.
Thank you, Pat. We have one more witness inside the computer. Chris Cassidy, hello. Thank you for joining us today.
Hello,
Good to
how
see
are
you. Welcome to Ways and Means. Really glad you could join us to testify.
Yeah, how best to proceed? Do you want me to read a statement or answer questions, or what would be most helpful to all of you?
If you wanted to start off reading a statement and then maybe we could ask you questions after that, does that work for you?
Sounds great.
And if it's a written statement and you're able to submit it to us, that's great too. And maybe you did that already and I just don't know.
No, I'm not.
Okay, great. You can send it to the same email address that invited you.
Okay, perfect.
Thank you.
Yeah, well, thank you, Madam Chairwoman, Vice Chairman, distinguished members of the committee. My name is Chris Cassidy. I've been an employee owner at Trust Company of Vermont for the past 20 years. We have offices in Brattleboro, Rutland, Manchester, and Colchester, Vermont, as well as Keene, New Hampshire, where we work with high net worth individuals in asset management, financial planning, trust administration, and estate and tax consultation. I am not a lawmaker nor a CPA, and I'm not opposed or in favor of the proposal presented. I assume that I was asked to testify because Trust Company of Vermont has potential insights into high net worth individuals, some of whom would be impacted by the proposal. I want to make clear that every individual we work with has different opinions on taxation, but I can try and summarize some common client interactions that may be relevant to these discussions.
That sounds perfect.
Okay, we use a software program called eMoney, which helps clients with financial planning. Traditional IRAs came about in the early 1980s with the Economic Recovery Act, and a lot of individuals retiring now have substantial portions of their net worth in traditional IRAs or traditional 401ks. So clients will often ask us to run financial modeling scenarios with them remaining a Vermont resident for the remainder of their life versus, say, moving to a state with no income tax like New Hampshire or Florida. Due to state income taxes, in some instances, again, everybody's different. The financial projections could show that individuals may not have sufficient means at their desired spending level if they stay in the state and live well beyond their life expectancy. But if they were to move out of state, they may not run out of assets. So obviously this proposal would have impacts on those calculations and that decision for certain retired Vermonters. I know that the state has been trying to get young professionals to move to Vermont, which is great. If you're, say, a surgeon considering moving to Vermont and plan on having an income of 600, 700, 800,000, you would fall into the 12.7% tax bracket, at least the latest iteration that I saw from the proposal. For that individual, they would be paying, 50, 60, 70,000 annually in Vermont state income taxes that they wouldn't be paying if they instead settled down in the state with no income taxes. And 50, 60, 70,000 annually growing at 7 to 8% in a diversified portfolio over a long period of time can add up to a pretty meaningful sum, particularly when considering family formation or saving for retirement. And so this proposal would impact those calculations that young professionals might be running when deciding where to live. The proposal could impact different regions of the state differently. We have offices in Brattleboro, Vermont, and in Keene, New Hampshire. We've had some current and prospective clients that have asked us about the potential of moving from, say, Windham County to Cheshire County because of the proximity, whereby you can maintain the same social groups and proximity to family, but be subject to lower taxes. I don't think anyone currently residing in Chittenden County would want to drive 2 hours from, say, Littleton, New Hampshire to Burlington every day, for example. It is important to note and stress that we have clients that want to live in Vermont for all the great reasons that we all decide to, and be residents of Vermont no matter what happens with taxation. So these individuals would absorb the increase in taxation proposed without any desired changes in domicile. Unfortunately, I don't think that I can offer any suggestions that you aren't currently considering. I can offer a few items to ponder. The Massachusetts millionaire's tax is a 4% surtax on annual income over $1 million, effective since 2023. California's top personal income tax rate impacts income levels around 1.5 million and above. Certainly the Vermont investment proceeds tax in the 12.7% bracket is currently proposed impact people at income levels that are well below $1 million. This is a very complicated issue that dovetails with other issues facing Vermont and other states. A New York Times article that I read last week entitled "Americans Have Fled to Red States, Blue States Can Win Them Back" notes how state affordability, such as housing, is a key driver in people's decisions about where to live. And I appreciate the work the legislature and treasurer's office have been doing with housing affordability. So thank you for that. According to the 2022 tax data, 3,560 personal tax returns with adjusted gross incomes of $500,000 or more represented about 1% of all personal tax returns, but accounted for over 30% of all net Vermont personal income taxes paid. Because such a small number of people have such a large impact on Vermont tax revenues, a lot of due diligence is warranted. And I appreciate the process and applaud the committee for involving the local business community in these discussions. If there's any questions I can answer, again, admittedly not a tax expert, I'm happy to do so. Thank you.
Thank you. Questions?
Sure. So, Chris, thank you for the testimony. I'm wondering if, when in your clients that are living in Brattleboro, thinking about Keene, has that actually occurred amongst your client portfolio?
I've seen it occur. I wouldn't say it's a frequent occurrence, but I have seen that.
And in structuring your clients' trusts, then do you often move their assets into a different state where there may be a more favorable income tax treatment? Without naming names. Yeah.
Yeah, I mean, I think like we have an office in Keene, New Hampshire. New Hampshire has slightly different rules. The main one being there's no rules against perpetuity for trusts in the state of New Hampshire. So if you were to use a trustee that has a presence in New Hampshire, you could set up a trust there while you're alive, a revocable trust. But I wouldn't say that we mostly work with people in Vermont and New Hampshire that want to be in those states and try to help them use tactics to allow them to stay wherever they want to live, as opposed to telling them to, move money to a different location or physically themselves move to a different location. Generally, those conversations start with, where would you like to be? And then what strategies can we provide to help you get there?
Fair enough. Thank you.
Anyone else? Thank you so very much for your time today. I really appreciate it. I think we all do.
Thank you as well. Again, I really appreciate the discussion. And if you have any follow-up questions, I am happy to be available.
Thanks. As we come closer to more final language, we might be in touch with that as well, if you don't mind.
Great. Sounds wonderful.
Okay. Thank you. Take care.
Thank you all.
I think that is all of the testimony for today. Did I lose anyone? Okay. Thanks, everyone. I don't think Nolan was here to answer the questions that Nolan answered. Okay. See everyone tomorrow at 9.